Hello and welcome to the Deep Dive. While U.S. markets saw a bit of an uptick overnight on hopes the Fed might slow down its rate hikes, things here are a little different. Today, both the KEGO SPI and KOSDAQ are seeing some minor adjustments, sort of a slight downward trend, mainly due to profit-taking and some fallout from NVIDIA's drop. Meanwhile, the $1 exchange rate is holding steady in the mid-1350s, which, keeps everyone on their toes.
It really does. And in such a complex global financial environment, it's crucial to look at how the key players in Korea's capital markets are planning to navigate these challenges. Today, we're going to dive into three key stories that give us a real window into capital flows and corporate performance, both here and abroad.
Great. So our first deep dive is on MBK Partners, Northeast Asia's largest private equity firm. They've just raised a massive new fund and are also talking a lot about a new vision for responsible investing. I'm seeing here they've secured commitments for their sixth buyout fund, totaling around 8 trillion won, which is about 5.5 billion US dollars from global investors.
That number itself is staggering, but you have to see it in context. Right now, the global private equity market is in what they're calling a funding drought. High interest rates and tight liquidity make raising a new fund incredibly difficult. So the fact that a full 80% of their major limited partners, the LPs, reinvested in this fund is, well, it's a massive signal. It shows absolute trust in MBK's track record and their dominance in this region.
It's more than just trustworthy, isn't it? That kind of loyalty would be impossible without a long history of partnership and, I guess, consistently high returns.
Yeah.
But it's also interesting that while they're raising all this cash, they're really pushing this responsible investing angle. I mean, there has been some public controversy around how private equity handles corporate turnarounds recently.
That's the key. At their recent annual meeting, MBK highlighted performing social responsibilities beyond financial returns as a core vision. And this isn't just PR to quiet down the critics, it's become a prerequisite. The big institutional investors, the LPs themselves, are strengthening their own ESG, that's environmental, social, and governance criteria. So for a firm like MBK, it's essential for sustainable fundraising.
And they did point to a specific example of this in action, which I found interesting. With the Home Plus turnaround, they didn't just sell off assets and walk away. During the crisis, they issued a public apology, set up a social responsibility committee, and even had management contribute their own money to protect employees and suppliers. That feels like a statement that they want to be seen as long-term partners, not just short-term profit takers.
Exactly. So with that philosophy in mind, we have to analyze where they're planning to deploy this new 8 trillion won fund. The key areas they've laid out are AI, healthcare, consumer industries, and this is a big one, the Japanese market.
The excitement around Japan seems particularly high. According to our source material, the average internal rate of return, or IRR, for the Japanese private equity market was 31.2%. That's significantly higher than the U.S. at 27.1% or Europe at 21.7%. What explains that gap?
It's a direct result of the Japanese government's corporate governance code reforms really taking effect. Since the mid-2010s, the government has been pressuring companies that were inefficient or ignored shareholder value. This created the perfect environment for private equity to acquire undervalued, quality companies, innovate their management, and just maximize their value. I mean, the numbers prove it. MBK's own portfolio companies in Japan saw their revenue grow 1.5 times and their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, grow 2.5 times after acquisition.
So in this high interest rate world, Japan has emerged as one of the most reliable places to invest. What about their domestic strategy here in Korea then? Conditions here are obviously tougher, with high rates and tighter liquidity.
And that's precisely why their domestic strategy has shifted. In Korea, MBK is expected to focus on non-traditional capital investments like mezzanine financing. Mezzanine is basically a hybrid between debt and equity. Think convertible bonds or CBs and exchangeable bonds or EBs. Because it's so hard for companies to get regular loans or issue new stock right now, there's been a surge in demand for these private debt instruments. They're relatively safe, but also offer the potential for high returns if the company's stock does well later on.
Okay, so let me see if I've got this. Korean companies need cash, but bank loans are expensive and the stock market is weak. So private equity firms are stepping into this gap, offering financing that lowers their own risk but still lets them share in the company's future growth. It's a strategy that really reflects the difficult fundraising environment companies are facing right now.
And one last thing on MBK, their internal innovation is also pretty remarkable. They're using an enterprise-wide AI platform called Project Athena in every stage of the investment process. They're apparently using it for over 20,000 cases a month, which shows that this digital transformation push in private equity isn't just a buzzword. It's a real tool that's maximizing the efficiency of their investment analysis.
So while MBK Partners is positioning itself as both a responsible investor and a leading innovator with this huge $8 trillion fund, let's turn our attention inward and look at how Korean-listed companies have actually been performing.
Right, our next topic is the third quarter earnings results for Keiko's PI and KOSTQ listed companies. The headline is this. On a consolidated basis, Q3 operating profits were up nearly 30% compared to the same period last year. For the KOSPI, it was 28.03%, and for the KOSDQ, 28.84%.
A 30% growth figure sounds fantastic on the surface, but you have to dig into the details, right? The total operating profit for KOSPI companies was 69.2 trillion won. But the driving force behind this increase was really concentrated in what we can call the 1-2 punch of semiconductors and shipbuilding. From a qualitative standpoint, that concentration might be a bit of a concern.
That's an excellent point, and the numbers make it very clear. Samsung Electronics and SK Hynix, just those two semiconductor giants, accounted for 7.3 trillion won of the total 15.1 trillion won increase in KOSPI operating profit. That's 48.4% of the entire growth. SK Hynix, in particular, led the way with a massive 61.93% surge in operating profit year over year.
So nearly half of the KOSPI's entire growth was driven by just two companies. On one hand, that's a positive sign that the semiconductor cycle is back in a boom phase, but on the other, it really highlights the Korean market's heavy reliance on a few specific large-cap stocks. If the semiconductor recovery were to slow down for any reason, the shock to the overall market would be huge.
Beyond semiconductors, the recovery in the shipbuilding sector was also very strong. HD Korea Shipbuilding and Offshore Engineering was up 164.5%, and Samsung Heavy Industries was up 98.6%. Just explosive growth. This really means that their order backlogs for high-value ships are now hitting the delivery stage, and they're finally solidifying their move into profitability after years of losses. And we also saw strength in bio, with Samsung Biologics jumping 115.27%.
So we had these clear growth sectors: shipbuilding, semiconductors, biodriving performance. But not every company was riding that wave. The mixed results within the secondary battery sector are something investors should probably pay close attention to.
Absolutely. LG Energy Solution continued its growth, up 34.14%, thanks to the steady EV market and its contracts with major automakers. But on the flip side, Samsung SDI actually swung to a loss, citing intensified competition and demand adjustments from its key clients. This shows that you can't just lump the whole secondary battery market under the simple banner of growth industry anymore. The fortunes of individual companies are starting to diverge based on their technology, their client portfolio, and their inventory management.
And the reverse growth in the auto sector was also quite shocking. Hyundai and Kia saw their operating profits fall by 29.14% and 49.25% respectively. What were the main factors holding them back?
The biggest variable was the impact of high U.S. tariffs. While a favorable exchange rate helped offset some of that, the core issue was the combination of tariff burdens and the sustained high interest rate environment in the U.S. This really squeezed consumer demand, especially for individuals relying on financing for their car purchases. It just made it much harder for Korean automakers to maintain their price competitiveness, and profitability fell sharply as a result.
So in the end, the Q3 results really paint a picture of a clear K-shaped recovery. A powerful rebound in specific sectors like semiconductors and shipbuilding pulled the whole market up. But other areas, like autos exposed to U.S. policy risks or battery makers facing intense competition, actually saw negative growth. Investors really need to be aware of this disparity and the concentration risk that's hidden behind the headline index growth.
Finally, let's shift our focus to an area that's emerging as a new investment destination in the domestic market: hotels. We're looking at an analysis from Kang Dong-nam, a partner at Deloitte Onjin who handles hotel M&A. He projects that the hotel market will see rapid growth through next year, followed by a period of stable upward momentum.
To figure out if that's a conservative or optimistic view, we need to understand why the market is expected to be so stable. In the past, the biggest risk for the hotel market was its reliance on a single country, right? Our source material notes that Chinese tourists used to make up about 55% of hotel guests in Korea. The key point is that this has now dropped to around 20%.
Exactly. As the proportion of Chinese tourists has decreased, the number of guests from the US, Europe, and other Asian countries has significantly increased. This means the market has transformed into a much more diversified and stable structure that can absorb shocks from, say, a diplomatic dispute, a pandemic, or a policy change in one specific country. The market's fundamental health has improved.
So in the past, an event like the Thanad missile crisis could send the entire hotel market reeling because of a change in one country's policy. Now, that risk is substantially lower. Besides the diversification of foreign demand, are domestic trends also contributing to this stability?
Of course, the Hokkans trend, a portmanteau of hotel and vacants or vacation, really took off in Korea after the pandemic. This secured a stable base of local demand. And what's more, the ways people use hotels have diversified. It's not just for overnight stays anymore. Hourly bookings or just using the hotel's food and beverage facilities have become common. This provides a really strong foundation of domestic demand, especially for luxury hotels.
The demand side definitely shows a structural shift. And I imagine that's had an effect on the M&A market for hotel properties as well. There's an analysis that it's now a seller's market.
Yes. Among investors, hotel assets are no longer seen as just real estate. They're recognized as core portfolio assets that generate stable cash flow. There's particularly high interest from foreign investors, and they've moved beyond just submitting high bids. Now, you have to present a concrete strategy, like an equity investment proposal, to even have a chance at an acquisition. This really shows just how attractive the market has become.
So it's moved beyond a simple bidding war to a competition that requires a complex investment strategy, combining management plans and partnerships. It seems that both domestic and foreign capital are navigating this crisis by shifting towards sources of stable returns, whether it's Japan, mezzanine financing, or the de-risked hotel market.
Meanwhile, the earnings growth of domestic listed companies is concentrated in specific sectors like semiconductors and shipbuilding, suggesting that while the overall numbers look good, a broader improvement in the market's overall health might still take more time. Understanding this gap between the movement of capital and the reality of corporate earnings is really the starting point for making wise investment decisions.
We've covered a lot today, from MBK Partners' vision for responsible investing and their strategic focus, to the polarized Q3 earnings of Korean companies, and finally, the trends in the hotel market.
We hope that today's deep dive into the reporting from the Seoul Economic Daily Securities team has been a helpful reference for your own investment decisions.
We'll be back next time with more essential information to help you understand the key trends and hidden contexts of the market.
Thank you. This has been the deep dive from the Seoul Economic Daily.
The content provided is for informational purposes only, and all investment decisions are the sole responsibility of the investor.